Most people think an ETF is just a ticker, a box you buy on a brokerage app. But when the first real XRP ETF quietly opened, the public conversation jumped straight to price charts and supply shock theories. Almost nobody stopped to ask the foundational question: what actually happens behind the scenes when you buy a share of an XRP ETF? Everything here is for educational and entertainment purposes only, not financial advice. Always do your own research before making any investment decisions. If clear, no hype crypto education helps you make sense of all this. Hit like and subscribe. It tells YouTube this series is worth showing to other newcomers, and it helps me keep building it for you. Today, we're fixing that. This is part 1 of a 5-part deep dive into the institutional era forming around XRP. You can watch this series in any order, but starting with part 1 gives the clearest foundation. And you don't need to have watched any other video to understand this one. I'll walk you through the ETF mechanics from the ground up, cleanly and simply. If you caught my earlier launch week episode, some of these concepts will feel familiar but not repeated. This is a brand new story focused on the long-term structure, not the opening week noise. By the end of this video, you'll understand how physically backed XRP ETFs operate, why each share represents a floating amount of XRP rather than a fixed number, how authorized participants and OTC desks move liquidity around, and why the macro environment, from QT or quantitative tightening to China's liquidity injections, matters more than most people realize. Let's start at the foundation. Picture a trust, a regulated legal vehicle whose only job is to hold XRP and issue shares representing proportional claims on its holdings. When you type a ticker like XRPC into your brokerage account, what you're buying is a slice of that trust. But here's the twist. Your trade doesn't make the trust go buy XRP on your behalf. The ETF structure is designed so that most trading happens between investors themselves, meaning your buy order is usually matched with someone else who is selling their shares, not with the ETF going out to acquire new XRP. The only time the trust actually needs more XRP is when demand becomes so strong that authorized participants must create new shares to meet it, and we'll get to that in a moment. At the center of the system are authorized participants, usually large trading firms or banks, who can create and redeem shares in bulk. If demand for the ETF rises and the market price sits above the value of its XRP holdings, APs step in. They buy XRP on the open market or source it through OTC desks, deliver it into the trust, and receive new shares. This process pushes the ETF price back toward its net asset value. If the ETF trades below its underlying value, APs buy shares, return them to the trust, and receive XRP back. Arbitrage keeps everything aligned. So when you see a stat like 10 XRP per share, treat it as a snapshot, not a rule. That ratio is simply the trust's XRP divided by its outstanding shares. And it drifts over time. Fees, expenses, creations, redemptions, and XRP price movements all adjust the math. The ETF is not required to hold 10 XRP per share forever. Now let's look at what's happening in practice. Canary's XRPC fund is live. With hundreds of millions of dollars in assets and steady daily trading, Franklin Templeton's XRP ETF launches next, with Bitwise preparing a cost-efficient alternative right after. These issuers are tapping the same underlying XRP markets, but through different operational structures and custody models. From an investor's perspective, these are just tickers. But behind the scenes, ETF demand interacts with XRP through a series of invisible pipes. When advisors or institutions allocate money into an XRP ETF, most of the time, their orders are matched by other ETF investors, meaning no new XRP moves. Only when demand overwhelms existing supply do APs create new units, and that's when actual XRP is sourced. Crucially, APs rarely go to public exchanges first. OTC desks, which specialize in handling large blocks without moving the visible order books, are typically their starting point. This is why you can see large ETF trading days without watching exchange supply collapse. The ETF is not a vacuum, it's a balancing mechanism. And creations and redemptions are lumpy, not linear. They happen when liquidity conditions create an opportunity, not on every trade. Now, zoom out. If you look at timing, these XRP ETFs are launching during a subtle but important macro turn. The Federal Reserve is slowing and preparing to end its quantitative tightening cycle. The Treasury General Account is no longer aggressively rebuilding, easing pressure on private liquidity. And in China, the central bank has pumped huge amounts of liquidity into its economy, cutting reserve requirements for banks and signaling a more accommodative stance. Why does any of this matter? Because ETFs are not just financial products. They're channels that respond to the broader liquidity tide. When liquidity shrinks, investors de-risk and ETF flows dry up. When liquidity expands or stabilizes, ETFs become a natural, low-friction way for institutions to add exposure. XRP ETFs are launching into an environment where investors are hungry for diversification and yield again. This is also where the bigger picture begins. An ETF is not the endgame. It's step one. It's the compliant wrapper that institutions use to test an asset before they ever consider holding it directly. Later in this series, we'll talk about Ripple's custody stack, RLUSD, as a cash leg, and institutional tokenization. But not today. For part one, just remember this. ETFs are the bridge that makes those deeper integrations possible. So, let's put this all together. XRP ETFs change three things: access, signaling, and plumbing. They make XRP exposure as simple as buying a stock. They show regulators and issuers are comfortable offering XRP in a regulated format. And they connect traditional portfolios to XRP liquidity through authorized participants and custodians. What they do not change is the XRP ledger's underlying economics or supply schedule, and they don't guarantee a price outcome, positive or negative. But here's why this moment matters. For the first time, XRP can sit inside retirement accounts, model portfolios, and institutional allocations without requiring anyone to touch a crypto exchange. That's not hype, it's infrastructure. And infrastructure is what stays standing long after daily headlines fade. Looking forward, there are a few reasonable possibilities, none guaranteed. If demand grows slowly and consistently, ETF shares will be created at a manageable pace, with APs sourcing XRP through a mix of OTC and exchanges. That path creates a steady background bid under the market, not a violent supply shock. It's boring, but healthy. A more volatile path is one where ETFs, tokenized financial products, and corporate treasuries all start pulling from the same liquidity pool at the same time. Under those conditions, exchange order books can temporarily thin out, forcing APs to pay higher spreads to secure XRP blocks. This doesn't mean supply disappears. It means the market adjusts dynamically. Higher prices attract new sellers and hedgers. Liquidity rebuilds. Markets find equilibrium. Now, the most forward-looking scenario is that ETFs become the front door to a much larger institutional footprint. Someone starts with an ETF allocation, gets comfortable, and later explores direct custody, RLUSD settlement, or on-ledger tokenized assets. It's speculative, but it mirrors what we've already seen with Bitcoin and Ethereum, where ETF adoption eventually led to deeper engagement with the networks themselves. And this episode sets the foundation for the rest of the series, where we explore how liquidity, institutional behavior, and real on-ledger demand connect. Next, in part two, we're stepping into flows, liquidity dynamics, and the real debate around XRP supply. You've seen the charts online predicting that exchanges run out of XRP in 12 months. Some are thoughtful. Some are fantasy. We'll break them down, compare them to Bitcoin's ETF history, and map out a realistic range of outcomes. This channel is for educational and entertainment purposes only, and is not financial advice. Always do your own research and keep the discussion respectful. If you enjoyed the video, please consider liking, subscribing, leaving a comment, or sharing it with a friend.